Hello, everybody. Ed Yardeni here in Long Island, where it's hot, humid, sunny. And guess what? It's summer, so all that is consistent with the time of the year. Also consistent with the better the fact that a lot of the issues that were hanging over the market have become less concerning. We've also seen the stock market rally here since April 9th, when President Trump decided to postpone his Liberation Day reciprocal tariffs. And then we've also seen things kind of cool off, at least for now, in the Middle East. You can never really count on things to permanently calm down in the Middle East. Back to the biblical times, there's always been problems over there. But for now, relative to some of the potential worst case scenarios, things have basically come up with at least in a short term, best case scenario with a ceasefire between Israel and Iran. Another issue hanging over the market since January was that whole DeepSeek thing, where in late January, the Chinese DeepSeek company introduced a new, cheaper, large language model to do artificial intelligence, and apparently it ran on much simpler chips, NVIDIA chips, than the models here in the United States. So it seems to be a lot cheaper, and that raised a lot of alarms that maybe American companies were spending way too much, billions and billions of dollars on AI infrastructure, and that they would never get a return on that, and that they would have to scale back their spending as they kind of realize that. Well, we did have the earnings season in April, and during that earnings season, a lot of the AI-related companies, the cloud companies, the Magnificent Seven companies that are involved in all this, they basically said that they're going to continue to spend tens of billions of dollars. Last estimate I think I saw for this year was something, well, I didn't see it. We also wrote it up, but sometimes my memory doesn't get it precisely right. But I think I'm in the right neighborhood, ballpark, when I say that the estimated spending on AI infrastructure by the major cloud companies is something in the order of 300 to 350 billion dollars just this year alone, and they didn't back off on that. They remained committed in their conference calls. They said they were going to continue to spend that kind of money. There's clearly still a lot of controversy about AI. There was a article, again, I read so many things, I don't remember exactly where it was, but it was an article by some researchers who did some testing of AI models to see what kind of answers they came up with. And the fact of the matter is that AI models that basically suck in all the information that's available on the internet are prone to hallucinations. They come up with some real well, garbage in, garbage out. The problem is that these large language models, as they kind of get fed all the information, both good and bad, that's out there, and they start to incorporate some of the bad information and come up with bad conclusions, that tends to create even more garbage in the internet. So that's a real issue. There's also the issue of racism. Apparently, there's a lot of racist ideologies that are expressed on the internet, and so if these LLMs are exposed to all that, they get influenced by it, and they can become very, very racist. Is kind of the bottom line. I mean, to put it bluntly. On the other hand, if AI is used just with clean data that your company has set up or that you've bought and you've vetted and you know is good data, and it's purely related to a certain task at hand, it works very, very well. It's basically kind of autofill on steroids. And another way to look at it, when you're typing and the word program tells you what you might want to put in next. That's kind of what it does. It's also a great research assistant. I use it all the time as a research assistant. And with Google, you get the sources, and then you've got to read the sources and then kind of glue together the story. With AI, you kind of get to cheat a little bit and to get ahead of the process. And basically, it's a research assistant. And as you know, some research assistants are pretty bright and some are not so bright. In the case of AI, it's probably somewhere in between because it really doesn't know what's right and what's wrong. But again, if you keep it relatively clean and focused on the data and the sources that you're interested in, I think it's actually a pretty useful research assistant. And I use Grok, I use ChatGPT, and these things obviously are open to the internet. But as long as you kind of stay to a fairly limited topic, it can give you a relatively good summary of what you're looking for. And then these LLMs now do provide you with abilities to go to the source, to the actual article, or maybe excerpt from a book, and just double check things. The reality is, again, like any research assistant, whatever they give you, you can't just take it at face value. If something just doesn't sound right, doesn't add up right, you're still going to have to check it. So it's that does kind of cut into quality time. I mean, if it really worked well, I'd be sending out morning briefings that are written by by an LLM. But we tried that a while ago, and when we got the product out from the LLM, I read it very carefully and concluded that I'd have to spend more time correcting it and filling in what some of my thoughts are than it made any sense to have an LLM. So those are kind of some thoughts on how I see it all. But back to the stock market decided that, well, if these companies are going to spend tens of billions of dollars, a couple of $100 billion collectively on AI, then they must have thought about it. They must believe that they are going to be able to get a return on it. So that means that NVIDIA and some of the other semiconductor companies will continue to have lots of demand for their products. So technology has made a spectacular comeback in this V-shaped stock market correction and rally that we've had. The tariffs, I think once the president backed off on reciprocal tariffs on April 9th, the market concluded that he was going to be relatively flexible about it, that you couldn't really count on any sort of really bullying statement as being the definitive position that he was taking, that he was negotiating in public, whereas when he was a real estate developer, commercial real estate developer, his negotiations occurred in a room with other developers or politicians or labor unions, and they shouted at each other, and it was ugly if you were in the room. But that's kind of a game they play, and at the end of the day, they came up with the deal, and that seems to be happening. On Friday, the market kind of had a test of that. Trump said we're not going to negotiate with Canada anymore because of their digital tax on our IT companies. And the market sold off a bit on it, but not much. Also on Friday, we got news that the issue with regards to rare earth minerals with China had been resolved, so that kind of helped to offset things. But the market just doesn't take anything Trump says literally, especially some of the outrageous things, figuring that this is just part of the art of the deal, and you got to give the president credit. He's made some real progress using that approach. And there will probably be over the next several days, several deals signed between the United States and major trading partners. They won't be detailed deals. They'll be sort of framework deals, but I think the president wants to declare victory and kind of move on to other issues. The president's getting his big, beautiful bill. Looks like that's going to happen. There's still some possibilities that it'll get hung up and he won't be able to sign it by July 4th. But it probably will all happen. And to the extent that it does, my bottom line on it is that it's an extension of the tax cuts. It's more like if it weren't passed, we would have a big tax increase, and that would be a big fiscal drag on the economy. So I don't think it really changes all that much. I don't think net net it is all that additionally stimulative or the or a weight on the economy in the other direction. Um, I'm not quite sure what the next big issue will be coming out of Washington. Deregulation is something that kind of happens quietly or relatively quietly. With this administration, everything's kind of on full volume, but with regards to deregulation, things could happen without a great deal of noise. There certainly look like there will be more geopolitical pushes to get things more settled in the Middle East. I I think the administration is going to try to come up with something to put more pressure on the Russians to come to the negotiating table with the Ukrainians. I think that the administration believes that based on what they did and accomplished in the Middle East, maybe the Chinese will have second thoughts about invading Taiwan anytime soon. So maybe we have nothing to fear, but nothing to fear in the stock market. Here we are at a record high. It's as though we on February 19th we all decided to go on vacation, and we all came back now, and the market really hasn't changed very much. And the reason for that, of course, is that the market hasn't changed very much. In terms of earnings, we had a little dip in forward earnings. Not really much of a dip, but now it's back at a record high. And meanwhile, the big deal here is the forward PE, which was, I think, around 22 and a half back on February 19th. The forward PE is now back up to 21 and a half. Way things are going, it's basically matching where we were before this whole correction got started. So here I am again thinking that I can't dismiss the possibility of a melt up. I mean, it's been sort of a melt up recovery. I think it's one of the fastest, if not the fastest, recoveries in a correction. And a melt up means that the market will continue to move higher on valuation. 21, 22 is pretty high. Could we get to 25? If we do, I think that would again remind us of the melt up that we had in 1999. I did write before the correction that higher valuation multiples in this kind of level can be justified if you really believe that there isn't going to be a recession between now and, let's say, the end of the decade. And that's kind of been our shtick really since the beginning of the decade. Past 3 years, we've been saying we're probably not going to get a recession, even though the Fed raised interest rates dramatically, tightened dramatically. So far this year, we've been saying that we think the economy has proven its resilience, and the economy will probably not go into a recession as a result of the tariffs. We were not believers that DeepSeek was going to prove that the IT rally that occurred up to February 19th was in fact a bubble. And here we are with the market back up, partly on the perception that capital spending on AI and other technologies are going to remain strong, and partly on the idea that, partly under the reality that earnings during the first quarter were very strong. Analysts have been lowering their estimate for the second quarter to the point where I think, again, we're going to have a pretty solid upside surprise in the second quarter. And analysts are still holding on to their estimate for next year of $300 a share, which is what we're holding on to, up from $260 a share, $260 a share this year. So we don't think there's going to be a recession over the rest of the year. We don't think there's going to be a recession over the rest of the decade. It doesn't come with a money back guarantee. It could happen, but you got to say we've really seen a bunch of crises here where the economy is held up surprisingly well. The last recession was the pandemic recession, and it only lasted 2 months, and that was a very unusual situation, to say the least. And yet, since then, despite all the crises that we've had, here we are at a record high in the S&P 500 and NASDAQ. We have been since the beginning, well, actually, even before the beginning of this latest bull market in October 2022, we've been recommending overweighting information technology, including communication services. It's we kind of view them as one and the same. Industrials as an overweight, and financials as an overweight. We also, for a while, were recommending energy, and that was the one clunker, and we kind of gave up on that. I see that somebody's visiting us here. So obviously that didn't look too smart during the correction, but now it looks just fine as, in fact, the leadership has been regained to the upside this time by those particular sectors. Let's have a look at some charts and then do some Q&A. So let me share the charts. Here we go. Okay, so today's June 30th. In the morning briefing today, we discussed there's always something, Rosanna Dana from Saturday Night Live was that character was famous for saying there's always something, and it's always something. And here, now that we've got less fear on tariffs, less to fear on the Middle East, more confidence that the IT boom is in fact a fundamental one. We can still worry about things, and one of the issues that I think there's still some worry about is a slowing in the economy, that might in turn lead to slower earnings. I mean, you wouldn't know that that's a concern given the way the markets are performing, but when you read the financial press and you see what the bears are talking about, that seems to be a concern. And yet here the market, which is the S&P 500, is a component of the leading economic indicators. Here the market is at an all-time record high, nice V-shaped recovery. Back on April 7th, a couple of days before the administration backed off, postponed its reciprocal tariffs, we wrote that April 2nd, Liberation Day, which occurred on a Wednesday in the afternoon after the market was closed, we observed that Liberation Day was followed by two annihilation days on Thursday and Friday. And on April 7th, we wrote that we thought that the administration probably would have to back off on these. And if they did, then we get a V-shaped recovery. So that worked out rather nicely. NASDAQ, V-shaped recovery, heavy weighting of tech leading the way. Here's another kind of slice and dice of where the market is on a year-to-date basis. The S&P 500 is now up 5%. So the first half of the year, we've got a 5% increase in the S&P 500. A lot of us were talking about a third year of double-digit gains for the S&P 500 this year in terms of strategists. And a lot of us kind of backed off back in March and April as the tariff turmoil sort of heated up. But I mean, it's conceivable in a melt-up scenario that we would have a double-digit gain for the year. But we're aiming for 6,500 now by the end of the year. And in a melt-up, it could go higher than that. Interestingly, the XMEGs have actually outperformed the S&P 500 with a 6.9% increase, and the MAGs, the Magnificent Seven, are up 2.1%. And I think the Journal has an article today saying that investors are happy to see that the, the rally is kind of gone beyond just the Magnificent Seven, and it seems to be broadening out. And we've been waiting for this for a while, but we think that's happening. By the way, we never really got that phased by the idea that the Magnificent Seven were distorting the performance of the bull market. There's a lot of people who question, is this really a bull market if it's just being led by seven stocks? And we pointed out that if you take out the seven stocks, you still would have had a bull market. A lot of those other sectors were up 20% or a little bit more. It's just the Magnificent Seven were up a lot more. And so it was just a comparison issue. But all in all, I think before the correction, we had a relatively broad bull market, and I expect the same now. Interestingly, investors are still wary. The bull-bear ratios, both for the Investors Intelligence and for the AAII, those are still below their average over time. So that's kind of interesting that here we are at a record high. People are saying that there's too much bullishness around, but you're actually not seeing it in the sentiment indicators, which suggests that there's, from a kind of contrarian perspective, there's more upside to be had in the market. The issue here of the economy, whether it's slowing down, I think clearly it is slowing down. That's what the data show. First quarter, it was down 0.5%. It had been revised downwards, I think, from 0.2 or 0.3% down, so it's down 0.5. A lot of that was because of a surge in imports, but even consumer spending was recently revised down to a slower pace. We'll look at that in a second. But I still think unusually cold January and February weather had a lot to do with a weakness in consumer spending during the first quarter. And then clearly all the tariff issues, uncertainty, turmoil must have impacted consumer spending. We know that it actually boosted auto sales in April, and then auto sales took a reverse that in May. So that kind of had an impact on the latest consumption data for May. But on balance, since around February or so, we've seen the Citigroup Economic Surprise Index has been on the negative side, but not unduly negative. So this is indicators have been somewhat weaker than expected. Doesn't mean that they still didn't add up to economic growth, which is what we saw in the second quarter. The bond market sort of been confirming what we're seeing in the consumer sentiment in the Citigroup Economic Surprise Index, and that's the yield has come down on the perception that the economy is slowing. And this does kind of raise some issues about this debt crisis fear that's out there. The bond market still seems to be mostly driven by the perceptions of what actual inflation is, what anticipated inflation is, and what the Fed's going to do about all that, as well as, at least on a short-term trading basis, on whether the economy looks like it's, whether economic indicators are weaker than expected or not. And so the supply-demand phenomenon did pop up as an issue back in 2023 from August, September, October, when the bond yields went from 4 to 5%. But people thought 5% was pretty good. They jumped in and they did pretty well at that level. So we really haven't had a situation where an auction was a total disaster and nobody showed up. We can always anticipate people will show up. And now I'm just kind of trying to get my hands around the stablecoin idea, and it looks as though stablecoin may actually create some demand for treasuries. I guess in some ways, stablecoin basically converts treasuries into a money supply in terms of stablecoin. I don't know what the Fed's going to do with measures of M1 and M2 and how they'll incorporate stablecoin into that, but we're clearly going into a brave new world here with this in the crypto world. So real GDP here, it was down zero point 0.5 in the first quarter. A lot of that was because we had a huge surge in imports, front running Trump's tariffs. The federal government was actually down a little bit. Consumer spending, PCE goods. Let me see right there. Here's PCE was up barely, only 0.5, and that's real consumption. And again, we're blaming the weather. This is the Atlanta Fed second quarter. So this was the actual first quarter through third, the third revisions. This is the Atlanta Fed's GDP now estimates for Q2 of this year, and you can see that they're estimating now 2.9%. That has come down from 3.4%, so it's certainly slower. It's getting a boost from imports now being a negative. When imports is a negative, it's actually a booster for real GDP. PCE goods looks pretty good at 3.2%. Final sales look really quite good at 5.1%. So maybe we just have to sort of average the first and the second quarters, or maybe just forget about them, and let's see how the second half of the year pans out. The stock market's up. A lot of these uncertainties and concerns have been diminished. Why shouldn't we have a better second half of the decade? And the answer obviously is, well, let's see what happened in the labor market. Initial claims suggest that layoffs are remaining extremely low. Continuing claims suggest that it's getting harder to find a job. So yeah, the unemployment rate could maybe jump up to 4.4% from 4.2%. Maybe the market will get freaked out by that, but those are still full employment numbers, and that would not get us particularly upset. Personal income was down. Some people kind of got freaked out by that, but they had to have seen that Social Security was sort of an up and down phenomenon. It was down sharply. I think it was a timing issue. You can kind of see the Social Security. This is Social Security kind of rose and then it kind of fell. So it didn't maintain its trend, but now it's back to it. What else? You can read the rest on your own. Personal interest income. Personal interest income comes from the government having to pay debt, interest on its debt, other sources of interest income as well. And that looks like it's kind of edging up now. It's up to about $2 trillion at an annual rate. Higher interest rates don't hurt consumers on balance. They hurt people who have non-mortgage interest payments. They hurt people who have mortgage payments. But personal interest income itself is a significant contributor to personal income on the positive side. Consumer spending, again, you can look at that. That was down 0.1, but a lot of that was gasoline prices fell. And I think motor vehicles is also a downer here after being strong in April. So there's a lot of volatility here related to Trump's tariffs and the turmoil that was caused by that. But again, a lot of that's dissipated. Initial claims, the 4-week moving average is kind of swinging around, still in a range here. You could get kind of concerned about that as an indicator that there's some pickup in layoffs. And we know that technology companies have announced some layoffs, but all in all, it doesn't look like much of a problem for the economy. Duration of unemployment is increasing. Sectors performance. This is year to date, industrials, communication services, financials, utilities. All three have been our overweight recommendations. We didn't really focus on utilities, which have gotten the big boost from AI-related perceptions that we're going to need a lot of energy to power AI. Consumer discretionary has been on the weak side, but we're not concerned in terms of the macro economy. We think particularly the baby boomers will continue to spend in areas like healthcare, like leisure and hospitality. That's where the employment gains have been, and that continues. So why should the Fed lower interest rates in that scenario? Well, Trump's leaning on the Fed. There's two Fed governors that suddenly are saying, well, maybe we should consider a cut, if not in July, then certainly in September. The markets seem to think that there's going to be a couple of rate cuts between now and the end of the year. And markets have been wrong. We're still in the none and done camp, but we're not adamant about that. If we're wrong about the resilience of the economy in the second half, if the labor market looks weaker, the Fed will lower interest rates and the stock market will go higher. And then I'll be probably writing more about a potential melt up in the market. Um, so far, I've been wrong on the inflation outlook. I thought that tariffs would, in fact, get us back up to about a 3 to 4% inflation rate on PCD temporarily, anyways, and then we would come down. But I think inflation is turning out to surprise a lot of people. I think the reason for that is the tariffs are probably impacting durable goods inflation, as you can see here. But on the other hand, non-durable goods inflation has stayed, and that's food and energy to a large extent, but that's stayed very quiet. Obviously, energy prices have come down a lot. And then the services inflation rate has continued to take its sweet time, but it's going into it's been a going into a decline here, which is helping out a lot. So enjoy your July 4th. Let me take a couple of questions here. Let me open them. Yeah, enjoy your July 4th. Maybe we can relax a little bit after the turmoil and the ups and downs of the first half of the year. It was one heck of a roller coaster ride, but here we are back at a record high. Let me put on my other glasses here. And I had a question right at the get-go from let's see, Luzardo. Luzardo asked about what if Trump replaces Powell with somebody more to his liking. Obviously, he's going to want to do that. He's going to have to pick somebody that can get through the Senate. But what if this new Fed chair somehow was able to convince everybody else to lower the Fed funds rate to 1%? I don't think anybody's kind of talking about that. I think Trump wants the Fed to cut rates by another 100 basis points, which isn't really that crazy relative to market expectations. But clearly, any reduction in the Fed funds rate here will have the potential to drive the stock market higher. And given that we're already at 21, 22 on forward PEs, that means that PEs will get even more stretched. But hey, maybe this is the roaring 2020s, which is what I've been talking about for quite some time. Haven't mentioned it recently, but it hasn't really changed in terms of our thinking. We still think that this is the roaring 2020s, and maybe that'll continue to be the case. It worked in the first half of the decade. Okay, Vincenzo, in euro, the S&P 500 is negative for the year. Do you envision a scenario where stocks keep on going up and the dollar down, or is it temporary? I guess I was on CNBC with Scott Wapner on Friday, and he asked me about the dollars. I said, I'm a bit of a contrarian. I don't think I'm not bearish on the dollar. And he jumped in. He said, "Well, you're the only one that's not bearish on the dollar." So I basically said I was glad to hear that. I don't mind being contrarian in this regard, as long as I have some fundamentals behind me. And I think I've got the world's largest capital market behind me, so I think that'll help quite a bit. I think there's, a lot of this weakness has been relative to the euro, and I think ever since Draghi put out his report about what Europe should do to be more like the United States, the euro has been strong. I guess the assumption is that all these things are going to happen, deregulation and such. But I'm a little bit more skeptical about that. But on the other hand, we have seen Trump push NATO to increase their defense budgets to 5%. That obviously has had a positive impact on defense company stocks here and over in Europe. So a lot of moving parts here. Cactus, hi Ed, what do you think about 10-year treasuries here? Is it expensive based on your macro outlook? And also, what does potential melt up in S&P look like to get i.e., to get to 6,500 much faster in the next few weeks, or just a much higher end of the year level? Uh, yeah, I mean, we're still looking at the bond yield trading between uh, four and a quarter and 4.75%, with a midpoint of 4.5%. We're still kind of in that. We still think bond yields have kind of come back to normal. They've normalized back to where they were before the great financial crisis. So to the extent they're at the bottom of the range, we think maybe better than expected economic activity going into and out of the summer may bring those bond yields back up. And look, Powell may still be right, and I still kind of agree with the notion that once we get June, July, August inflation data, we'll see some pickup in the inflation from the tariffs. Could be wrong, been wrong so far, but that's still a possibility. With regards to a melt up, yeah, it's either one. We get to 6,500 a lot sooner than by the end of the year, maybe by the end of the summer or early fall, and at this time we don't have a September, October correction, which is kind of has happened in the past more often than not. And the other alternative possibility is that from there we go to 7,000. I mean, to get to 7,000, we're going to have to go through 6,500, obviously. Brian, interested in your take regarding a possible appointment of a shadow Fed chair. Is there precedence for this happening before? I think it's a horrible idea, terrible idea. I don't like it at all. There is a precedent. There used to be something called the Shadow Committee that was a bunch of monetarists who consistently criticized the Fed for not being monetarist. And they kind of presented dissenting opinions on a regular basis. Nobody paid much attention to them except other monetarists, so they didn't really have much impact. But here, having a shadow Fed chair that the president is empowering to speak on his behalf really raises some problems with the independence of the Fed. Look, even if Powell decided to stay as governor, not as Fed chair, he couldn't do that. Then the president would have to pick somebody that's in the Fed right now. He couldn't put in somebody outside from the Fed. There'd be no vacancy there, so he would most likely pick Chris Waller, I would think, because Chris Waller was appointed by Trump to be a governor, and so he might very well pick Chris Waller to be the next Fed chair. And if he does that, Chris Waller knows the other Fed people. He's been working with them. I think he'd have a hard time convincing them to give the president what he wants right away. And so you could have a lot of dissents, and the dissents could actually be Chris Waller and maybe Bowman, a few other people who do agree with the president that we should be lowering interest rates sooner, while others remain kind of on the cautious side. So interesting developments possibility. It could be negative for the dollar. Nobody wants to see confusion when it comes to monetary policy or for a testing of the independence of the Fed. So maybe that's what's going on with the dollar on the downside. Well, I've way overstayed my welcome. I know there's a couple of other questions here. Feel free to email me, and I'll see if I can respond either directly to your emails or mention it in our call next week. We will be here next week. We'll see you. I don't know if you like this new fashion line that Yardeni Research is thinking about going into a business of fashion. Others are going into ETFs. Maybe we'll do fashion. But again, we always appreciate you calling in, and we'll see you next week. Goodbye, everybody.